Welcome back. As we told you, markets are a little off highs at this point in time. Probably some shadows because of the power outage, and now the flashes are coming up for you. Most areas in Mumbai see a power outage. But we do have Rashesh Shah, Chairman and CEO at Edelweiss Group, joining us. Rashesh, glad to see some power at your end. More power to you. But can you just explain to us what is the position of NBFCs generally and your company in particular? The RBI has unleashed a slew of liquidity and very accommodative stance. We saw corporate bonds and CPs yields fall by 25 basis in some cases. Is money cheaper at your end? Is it available?
Yeah, I think if you go back in the last 4-5 months, I think the availability of liquidity has really improved, and RBI has done a lot of things, including the government schemes of LTRO, partial credit guarantee for NBFCs. Even the MSME scheme has eventually helped NBFCs also, because a lot of MSME customers have also got credit. So I think kudos to both government and RBI on making sure liquidity has been enough to make sure what was the environment of a crisis in the economy a few months ago has abated. So I think, yes, liquidity is easy. In fact, now for the first time we are seeing NBFCs starting to renegotiate interest rates and all with banks, because earlier, last 2 years, whatever was the interest rate, people just wanted liquidity. Now we are starting to see that people are becoming rate conscious also, and as you said, interest rates have come down. So I think liquidity is there. What we still don't see as much is the credit flow, especially credit flow outside of the scheme. So the MSME scheme, the PCG scheme, all those underneath the schemes, credit is flowing. But outside of the schemes, I think the normal credit flow that is required, especially the long-term, liquidity through the credit markets, is still not there. And we still see the bond markets are dislocated. Bond markets are still not back to even, about 60-70% of what it was pre-ILFS. So I think we have to get the bond markets stabilized. We have to get long-term credit flow started again, for the risk-taking and the investment cycle to start again.
Is that happening till AA, you would say, not below?
Actually, even below, I think the liquidity has improved. The rates have not come down as much. So I think availability has improved. I think, as you correctly said, below AA, the rates are not coming down as much, because as you see, spreads have increased. Because see, everybody has got liquidity, but everybody wants to keep it in the short end. Everybody wants to keep it in risk-free. So risk-free and short end, the rates are really down, but the long-term rates are still up. As you see, yield curve is high. That is what RBI has been doing, Operation Twist and all that. So I think the long-term rates, the risk premium, all these are still high. The short-term rates and the risk-free part of the markets are getting very cheap credit. So it's a very polarized market. But for all the market segments, liquidity is available. Cost is much higher for longer term and for slightly higher risk.
Okay, can you give us an idea of what has been the experience at Edelweiss itself in terms of collections?
Our retail collections, in April when the RBI moratorium was imposed, we had almost half the book, half the creditors, half the borrowers were under moratorium. Now it has come down to almost 20%. In fact, even the people who had taken the moratorium, I think more than about 50-60% of them have started paying again. A lot of customers, more than 50%, didn't avail moratorium at all. Now almost 80% of the customers are paying as per schedule regularly. So that is good news, because I think overall customers have held up fairly well. And I think a lot of our customers are in the formal and the semi-formal sector, and they are doing okay. I think in the informal segment, where we don't have a lot of products, because informal is where you are more in the rural or the tier 4, where you have to deal with, on the ground, giving cash, collecting cash. Since we don't have that whole, system out there, we don't experience the really informal part of the economy. But the semi-formal and the formal has held up well. And as I said, the government scheme on MSME, which out of 3 lakh crore, almost 2 lakh crore has been disbursed.
Okay.
Has been a big help to a lot of the customers.
All right. So what do you think would be the stress at your end? What percentage of the book?
So So as you said, I think our current NPAs are about between 2 to 3%. Our estimate has been, I think, if you look at impairment or credit cost, which is very important to look at, when we look at ourselves, when we look at banks, when we look at everybody, I think for the next 2 years, the impact of COVID should result in about 100 basis point of credit cost per year for 2 years. So overall, 2 percentage point should be the impact of credit cost or impairment on the credit books of NBFCs, banks, all of them. Of course, it will vary from individual to individual. For us, this is the estimate that we are working with purely as related to COVID. And that is why you would have seen most of the banks, most of the NBFCs have raised capital. And the capital raised, ironically or strangely, is also between 1 to 4% of the total book size. So if there is a bank with a 5 lakh crore book, and that bank has gone out and raised about 10,000, 12,000 crores of equity capital, it's about 2 to 2.25%. So that is what we are seeing across the board. As you have seen in Edelweiss also, we have raised almost 2,000 crore via the stake sale in the wealth management business. And this for us, for our size of the book, is almost more than 5%. So I think we have all made sure that whatever is a COVID related impact, you have raised enough equity for that, because it will result in impairment, which will be anywhere between 1 to 2% of your credit book over the next 2 years.
So what, for the entire NBFC business, what is the capital that you're standing at now, and are you planning to raise more?
For our entire NBFC business, on a 20,000 crore book, we have close to 5,500 crores of equity. So we have a lot of equity. More than 25% of the book is equity. Our capital adequacy across the various entities, the housing finance company has a 25% capital adequacy. Our retail NBFC has a 28% capital adequacy. Our ECL finance has more than 21% capital adequacy. So almost about 25% of the credit book is equity. So we are geared about 3:1, which is very, very conservative. When this ILFS crisis happened 2 years ago, we were geared 5:1. It has come down to 3:1 because we have all brought down the books, but also raised equity in that. So I think overall today our capital adequacy is about 10 percentage points higher than what is normally required from a regulator point of view. So there is a lot of equity. There is a lot of liquidity. I think growth and profitability are the two challenges that NBFCs will have to grapple with going forward.
Okay, but from now, say 12 months on, how much will mature in terms of your liabilities, and how much is the cash that you have for this?
So if you see Edelweiss Group as a whole, we are holding about 8,000 crores of liquidity on hand. Our gap, what we call the inflows minus outflow, is called the ALM gap. On the worst, assumption, very conservative assumptions, is about 4,000 crores a year. So ideally, you should have 4,000 crores of cash or liquidity a year to meet your ALM gap between inflows and outflows. We have close to 8,000. So in a sense, we have almost 2 years of ALM gap covered, or we have the next, 1 years of outflows also covered. So whichever way you look at it, I don't think equity and liquidity is a problem with NBFCs or even banks anymore, because the crisis happens when there is an equity or liquidity issue. That has gone away. Now that crisis has become a challenge. I think for a lot of parts of India also, there was a crisis 4-5 months ago. That crisis has abated, but now there is a challenge, and the challenge is a growth and profitability challenge ahead of all of us, rather than a crisis of liquidity and equity.
Right. Okay. Well, growth has several hurdles at this point in time, Rashesh. There is also not much demand, and of course risk aversion. Thank you very much for joining us with your perspective on the financial sector and on the NBFC space in particular. We're out of time on Bazaar, and unfortunately, as we wind down, the mid caps are seeing a 0.4% cut, and the banking space has lost about 3/4 of the gains it put on. So it's just about 1/3 of a percent